Let's get back to equities. More in today's trade. Chris Conway is joining us from the Australian Stock Report live from our Melbourne studio. Chris, welcome to the program. Good to see you.
Thanks, Nadine.
What's happening with the market today? Down by 0.3%. Is this a stock-specific story, or again, are we talking, weakness in the banks and the broader financials?
I think it's a bit of both. Obviously, there's a lot of stock-specific news this morning with the swathe of results that we've seen. We didn't have particularly strong leads from the overnight session, so we're really digesting what has happened locally. Banks weighing, miners and materials players getting a bit of a boost because of supported commodity prices. But on the whole, sort of just treading water. And the market's really been doing that for some time now. Technically, we've got a pennant pattern forming on the XJO chart. And these type of patterns typically precede big moves in either direction. So I think something is brewing.
Okay, so do you think that something is brewing to the upside or the downside? I mean, if we're talking catalysts, will reporting season potentially be that catalyst to change direction? And given that, or if that's the case, what do you make of reporting season thus far?
Yeah, so reporting season on the whole for me has been a little bit disappointing. We know that revenue growth has been very, very hard to find, and that's a theme that's been continuing over a number of seasons now. NPAT has had a bit of a negative surprise. Some of the cost out stories that have delivered strong results previously, they're starting to dry up. So fundamentals are challenging at the moment. In terms of the market breaking, well, that is the million-dollar question. Classic technical analysis would suggest that the market will break from the direction which it came, which means that it will push higher. For that to happen, we probably need to see the Federal Reserve say that they're not going to raise interest rates anytime soon, and we need to hold the current levels on the Aussie market through the remainder of reporting season. They're two big ifs and sort of unknown quantities at this point in time. So you asked me which way it's going to break, Nadine. Honestly, I honestly don't have the answer for you. On the balance of probabilities, given the weak local reporting season, I would suggest that maybe we retrace into 5,400.
Okay, so 5,400 is the level technically that we need to defend then?
Yeah, absolutely, absolutely. That was the top of the range, sort of that 5,350 to 5,400, really before we broke out recently for the best part of 12 months. So if we slip back into that range, maybe it becomes particularly difficult to break out once again. So I would absolutely like to see 5,400 defended at all costs. And hopefully the bulls can build a base of support from that level to launch their next attack higher.
Okay, let's talk some company specifics out on the market today. Sydney Airport, 19% rise in interim profit, $159.6 million. This has been a market darling in this low interest rate environment. What was your initial assessment of the result?
Look, I think the results were solid. I think they came in at the bottom end of guidance. There were some positives. There was stronger retail sales at Sydney Airport. Now, anyone who's been to Sydney Airport recently, like I have, will know that when you're paying $18 for a ham and cheese sandwich and $7 for a coffee, there's plenty of profit built into those sorts of numbers. So I think overall it was a strong result. I continue to like Sydney. I think it's a stock that you buy on pullbacks. They have a monopoly. They have the right of first refusal for a second airport in Sydney if and when that gets off the ground. So I do like it. Like I said, I think you buy it on pullbacks. The argument against it is that it is a bond proxy, being a growth stock. But we've been waiting so long for the US interest rate to start ramping up. The US Fed to start ramping up interest rates, and it hasn't happened. And we're never really going to know when it is going to happen. So I think you ride the momentum until you're proven otherwise, and you do that by buying the dips.
So today, currently down by 0.75% for our viewers watching at home. Is this the kind of dip that you're talking about, or something more significant?
Yeah, no. Well, this is the sort of dip. I noticed before I came to the studio that it had traded down to about I think $7.21, and quickly rallied off those lows. So obviously there's some people out there of the same opinion that I am, that when it does dip in any meaningful way, that you jump on it. So yeah, I think the dip that we've seen today will encourage some people back into the market like we've already seen. So anywhere around that 730, 720 region, I think offers pretty good buying.
Okay, so yield stocks and the chase for yield is definitely a hallmark of the Australian market, and I suppose equity markets in general around the globe in this low interest rate environment. But of course, we're looking for good growth, stocks with good growth. And we've heard from one of them today, it looks like Bapcor. BAP is the ticker code. It's amazing how much people have been talking about this in the past couple of days when we don't normally. A pretty solid result coming from this company.
Look, from where we sit, having bought it at $4.50, it's a truly exceptional result. I think it was an 89% rise in profit off the back of an 83% boost in sales. Of course, some of that was driven by the acquisition of Metcash's Autobarn and other associated businesses. But what this company has shown is that they can make acquisitions, they can do it efficiently and effectively. And the other big tick for me is the margins were up across the board. I think, to have exceptional growth like that, to have expanding margins, and to have an outlook that is suggesting 25 to 30% growth in profit in 2017, it really ticks all the boxes. Again, it's one of these bond proxies. It's a growth stock. Maybe it's expensive, but this is the environment that we live in. If you want growth, you have to pay for it, and I don't think there's any better example than Burson out there at the moment.
So you wouldn't be shy to pay $6.12 for the company, which is what it's trading at right now, up by pretty close to 6% today.
Not at all, not at all. Again, having bought it at $4.50, it makes it very easy to say that. But again, coming back to this bond proxy argument, again, the Fed has delayed and delayed and delayed, and looks as though it will continue to delay raising interest rates. And when they do finally raise interest rates, well, of course, the short-term interest rates will change, but the long-term, the 30-year Treasury yields may not budge all that much. So I don't assign as much weight to that argument, and I am happy to pay, as I said, a premium for a growth stock. Again, if you're looking over the long term, well, I think you'd want a stock that's going to deliver good growth, even if you have to pay more for it, as opposed to a stock that you'll pick up at a discount but won't deliver as strong a growth. So I think the arguments, whether you're a short-term trader, you continue to ride the momentum until, like I said, the market tells you not to, or if you're a long-term investor, I think the case can still be made that you should be buying these growth stocks.
Let's talk Whitehaven Coal. What a turnaround story. Swinging back to full year profit, the share price rising from $37 to $2.10 in 6 or 7 months. We were chatting with the CEO just a little bit earlier on. Let's take a pause and listen to what he has to say, I guess, about the cost out story happening with Whitehaven Coal.
You look over the last 3 years, we've reduced costs substantially. We are in the lowest cost quartile now, which is a good place to be, but that doesn't mean the journey stops. You've got to continue to drive that cost down even further. We will start to wash a little bit more coal at Maules Creek now, because the met market is certainly enjoying the quality that we're delivering. And when you wash a little bit more, you obviously incur a little bit more cost. But the margin improvement that comes is a multiple of that incremental cost, so it's well worth doing.
So well worth cutting costs, obviously a hallmark of what we've seen in the commodities space in particular. Do you think Whitehaven Coal has that much more fat to trim, or really when it comes to this company, is it a debt reduction story?
I think that's a double-edged sword. I think it's both of those things, Nadine. They surprised today in terms of even their own guidance, I believe, in terms of how they were able to trim costs. Their operating performance has been pretty exceptional. They've driven some benefits out of logistics. Of course, the lower oil price has helped, and indeed a rising coal price as well. So they have had some things break in their favour, but that takes nothing away from the fact that, as I said, the operating performance has improved significantly, and I think they can continue to deliver those cost reductions. And of course, they will use those cost reductions and those increased margins to continue to pay down debt. We must remember it was only 12 months ago that the debt load for Whitehaven was of huge concern to the market. So I think their more speedy reduction in their debt will be viewed very favourably by the market, and obviously we've seen that from the rise of 35 cents, as you say, to $2 and change as it is now.
But, I mean, are the big problems for Whitehaven Coal definitely in the rearview mirror? I mean, I was speaking with an analyst about maybe 3 weeks ago saying that it's not out of the question that Whitehaven would still have to, go back to some of its financiers and refinance some of this debt. I mean, is the market potentially getting too far ahead of this story, considering such a long and painful process it has been with Whitehaven?
Yeah, look, potentially, a really good question, but given their stronger financial position now, the better margins, the lower costs, you would think that going back to their financiers would be an easier task this time around than it was last time around. We all know how close it came to, potentially folding or being sold off. It's avoided that, so I think the journey now will be much easier than what it was. So Still a concern. I would definitely cede that point, but much less of a concern than it has been previously. But it's a similar sort of story for a lot of commodities-related companies that have benefited, of course, primarily from the bounce in the low point of commodities that we saw earlier in the year.
Are you in the camp that thinks that we're on an upward trajectory for commodities from here on in, that we've reached the bottom and the only way up is up?
I would agree that we've reached the bottom for now, but I would hesitate to say that the only way is up from here. We have seen a very, very strong recovery. There are still global growth concerns out there. There are still structural oversupply concerns in some markets, oil, namely, iron ore, namely. So there are still problems there. So that's why I wouldn't say I think the only way is up. I think they can continue to move higher, but I don't think it's going to be that straight line or near straight line rally that we've seen from the lows. I think it's going to be a grind from here.
Okay. Chris, it was really nice having you on. Nice to talk to you. Thank you.
Thanks, Nadine.
Chris Conway there joining us from the Australian Stock Report from our Melbourne studios. Well.